welcome. Welcome to this week's Fireside Chat with Soli, where we usually get questions from the community, and Nick presents us a presentation about some stuff, very useful stuff. If you haven't done so yet, and if you missed any of these episodes, you can go to the SpiritSwap's YouTube channel, and then you can watch the recordings. And they are very useful educational content. So I'll definitely advise you to do that when you have time. So for this week, we have a special guest, and Crypto Clay from FTM Alerts is with us. And before starting the show altogether, I just would like to thank the whole team of FTM Alerts, Clay, for the wonderful job that you have been doing so far. And it has been always a pleasure for us to watch and also provide some content to all these shows. So I really would like to, and I think this is really coming from the community, not only from myself, that we would really like to thank the whole FTM Alerts team. You are doing a great job, sir. And without further ado, I will leave the floor to Nick. I'm sure they already, by the way, there is a screen open right now. If you haven't yet, you can click and watch the presentation as well. So I'm going to leave the floor to Nick, and I hope we are going to enjoy the talk tonight. So, yes, Nick, how are you, sir?
I'm good, thanks, man. That was quite the introduction. Thank you very much, JJ, as always.
Yeah, thank you, JJ. We really appreciate it, man. We're always super stoked to do Phantom Unchained and just be part of the Phantom community. So greatly appreciated. Nick, how are you?
I'm good, thank you, my friend. I'm just gonna turn my push to talk off now that my toddler has retreated. Okay. And we're good to go. Oh man. Dad crypto life, eh? Yeah, look, good evening, folks. Welcome back to another Fireside with Soli. Thanks everyone for joining us. Look, I hope everyone's having a fantastic week. As JJ has already alluded to, tonight, we have a very special cameo appearance, a gentleman whom I'm sure every community member is aware of and familiar with, none other than the man, the myth, the legend, Crypto Clay. As JJ already stated, Clay's a member of the FTM Alerts crew, who's known for sharing his views on macroeconomics along with other things on the FTM Alerts show. Thanks, Clay, for joining us, man. Now, Clay, before we sort of jump into the topics of this evening, would you like to maybe give us a bit of a brief introduction about yourself, your background, how long you've been in the crypto market? Give us the Clay TLDR, my friend.
Sure, man. So obviously I'm Clay from FTM Alerts. I have been in crypto. I got in crypto in about 2017, early 2017. Actually, my dad read Silk Road. He's a boomer who's also in crypto.
Oh, shit.
Yeah, he's a rarity. But honestly, the guy I think knows more than I do. It's crazy how much he just scours crypto Twitter all the time. But yeah, so got in, kind of like everybody else, right? Like not having a clue what we were doing, and bought into Bitcoin and Ethereum and kind of rode through the 2018 2019 bear market and honestly kind of I sort of regret I lost a bit of interest where. The difference now, I think, is that we're all still here. We're really starting to apply, macroeconomics to what we're doing, and just really advancing kind of our perspective on the crypto space. And obviously, the emergence of DeFi 2.0 and all that stuff has completely changed the space entirely. But yeah, so got in 2017. Hung around, wasn't quite as active, and then. I actually came from sort of a 12-year media background. I worked at Galodian and Yahoo and NBC and ran sales teams for programmatic advertising for a long time, and had been good friends with Austin's brother. Actually, was one of good friends from college, and Austin was obviously heavily into crypto, and he and I linked up. And he was like, "Hey man, you should think about joining me with this FTM Alerts venture." And so we kind of got together in last year, and I quit my job and going full time into
Yeah,
this
boy.
this crazy space. So yeah, I mean, honestly, it's been awesome. And now we get to do things like this. So it's been a hell of a ride, and I think it's only going to get hopefully more fun once we get some of this stuff that we're here to talk about today straightened out. But yeah, so it's been great, man.
Absolutely, man. Buckle up, buckaroos. Clay's got some juicy stuff in store for you this evening, and yeah, fantastic. Thanks so much for the overview, Clay. Much appreciated, and to sort of echo, what you've just said, you guys, and what JJ just said, you guys are doing a fantastic job over at FTM Alerts. Austin and I are super tight. Ever since you and Austin kind of linked up on an official scale, I suppose, you and I have been chatting at least sort of once a week, and you and I have formed it's funny, one of these overseas crypto friendships, that hopefully when I'm stateside we're gonna meet up and kick it. So I'm looking forward to that, man. But look, it's a pleasure to have you on the show today, and thank you so much for your time in advance. Right, ladies and gentlemen, well, without any further ado, let's push on to our first topic of the evening. But before doing so, the the obligatory NFA. Look, the purpose of this fireside event is to have an engaged discussion. We're not registered financial advisors. We're degenerates. None of us are taken as financial advice. So with the obligatory NFA out of the way, yeah, let's sort of tuck in. So first to sort of, I guess a good way to sort of kick off discussions is, why we're here today, and what is our goals as investors and traders, and sort of before I leave the stage to you, Clay, my personal thoughts sort of fall into two categories here. Me personally, I'm here to give, just like Clay and the rest of the FTM Alerts guys, I'm here to give as much value as possible to the SpiritSwap community, whether the market is up or down. I'd like to impart as much value and knowledge as I possibly can to allow our community to make informed decisions, not just surrounding the governance of SpiritSwap specifically, like we discussed last week, but, in their decision-making process, throughout their daily trading activities. And by this, I mean, not tell you guys what to do with your money, but more so provide you with the thinking tools that could be handy to allow for a better thought process when making these decisions for yourself. In terms of goals as investors, and traders, that's a hard one. But I mean, I guess at the end of the day, and Clay, you might agree or disagree with me here, but we all have a common goal, and that is to make money. I mean, no one really enters the arena with the goal to lose, unless you're dumping 20 million worth of tokens on the open market with a covered 100x leverage short position on that token. I digress. Jokes aside, it does. People invest for many reasons, be it short term or long term, but the ultimate goal is to, I guess, improve one's prospects from a financial perspective. Personally, my financial goals fall into several categories that are rooted at sort of one base. That being financial security for my wife and even more my daughter. But also to improve my life quality, not having to slave away at a 9 to 5, allowing myself to have more time with my family and friends, converting profits into tangible real world assets such as real estate, but ultimately, build an empire for my queen, my 3-year-old daughter. But Clay, yeah, over to you. Let's hear your sort of thoughts on the matter.
Yeah, I mean, there's so much to cover here that I'm going to keep it super simple and super short. So my perspective is we are here to make money. Like all of the things that you said about supporting yourself and your family, obviously that starts with making money, right? So I think another big reason that we're here is to hopefully understand some of the key metrics that we really need to start to pay attention to, so we can effectively make that money. And really, it's to become more intelligent about investing, in my opinion. So, that to me, it's short and sweet. But if we can accomplish some of that here today, then I think we've done our job. So, yeah. So I think we're good to keep going.
Awesome. So, yeah, I mean, the current state of macro affairs. So again, look, my take real quick is, we've several main factors followed by, macro factors that are either symptomatic of these macro factors or sort of a cause of them. So, you've got the US who have printed more money of its money supply over the last several years than it has in its entire existence. The ECB, the JCB, the BOE, etc. They're all in a similar boat, sort of drifting down shit's creek without a paddle. Emphasis on the lack of paddle. We're coming out of what's been referred to as a global pandemic. I'll try not to get too political about things here, but in short, this inflation could be argued as a symptom of the pandemic. We've now got Russia arching up on Europe, causing supply chain issues, which in a sense, I guess, adding fuel to the current global economic dumpster fire that we find ourselves sort of gazing at, all slack-jawed, and all of which could be argued as causes of the DXY skyrocketing currently to, Clay, you'd probably be able to correct me here, but I think it's at the highest point that it's been in the last 20 years, I think.
20 years.
Yeah, 2000, 2000, I think was the last time we saw it at where it's currently at 107.
2002.
2002, there you go. So yeah, Clay, look, now that I've had my rant to set you up, please oblige
Sure.
and, as they say, knock them down. Give us your take on the current state of macro affairs.
Yeah, so I mean, I apologize in advance, guys. I've got probably too much to say in this hour, but we're gonna try to make it through. So let's run through the actual sort of currents and just FYI, my perspective is very much U.S. based. I mean, I'm based in Florida, so when I speak, I'm really speaking about the Fed in the context of the United States, and really any stats that I'm probably going to throw at you are from our the perspective here. But just know that the global economy is suffering the same sort of symptoms as the U.S. So let's kind of run through what we're seeing, right? So the latest CPI print was 8.6%. So inflation is just pretty much out of control. Mortgage rates, because of rate hikes in the United States, are now about 5.6%. So they've doubled in the last, 2 months. The Fed has done a 50 basis point hike, a 75 basis point hike, and all signs seemingly point to July also being another 75 points. And just for context, this was the first 75 point basis hike in 30 years. So, I mean, we're like pretty much in, arguably unprecedented territory.
Yeah.
What's that?
Crisis mode.
Yeah, I mean, it's unprecedented, right? So, and the 10-year Treasury yields are moving higher. The yield curve just inverted versus the 2-year, and we're gonna talk about what that means for yield curve inversion. And really all this is resulting in the Fed fund. So the Fed fund rate. So basically the rate that banks charge each other for overnight loans needed to maintain their reserve requirements is rising. So it's now 1.75%. For context, a year ago it was 0.25%. So the banks are effectively, their fund rate is higher, and they are now squeezing, the loan market. They're making less money. It's affecting everything that we do. Tech stocks are down 40%, and that happened in the blink of an eye. This is the second worst start to the equities market in the last 50 years. And Q1 GDP for the US was minus 1.6%. And based on the Atlanta Fed's estimates that came out or sort of finalized 2 days ago, they're expecting another minus 2% for Q2. So two quarters in a row of GDP loss basically means a recession. I'm going to assume that with the midterm elections coming, that the media is not going to tell you that, but let's be honest with ourselves. So we have all those factors, headwinds against us. So Nick, I'll stop there. Anything you want to add? Or?
Yeah. Look, amazing introduction, Clay. And look, thanks for your take. I suppose as per one of the main points that sort of I touched on and you spoke on there. It's a perfect segue into the next topic being being inflation. The what, the why, the when, the how. I'm sure many of our community members are familiar with the dreaded I word, but Clay, in your own manner, would you mind giving us a rundown on inflation, possibly define it, perhaps give us your perspective on whether the Fed tools are effective at this point in time?
Yeah, absolutely. So before we do that, I want to back up just slightly. So
Yeah.
the bond market sees a recession coming, the stock market sees a recession coming, the crude market is, sees a recession coming, and likely the housing market, right? So I think the questions, the questions we need to ask ourselves are how or why didn't we as the crypto community see a recession coming? The up all, the up only culture. How do we
Mm,
miss that? How do we
mm,
miss the risk off, market coming, and how, why didn't we see this BTC sell off coming? And I think on Unchained, we've really started to realize that the macro global perspective is massively overlooked in this space. Um, but if you look at the trends, right? So the market's forward looking, right? 3 to 6 months on average, and there's always warning signs along the way that things might get ugly. And my take on it is in crypto we get so lost in the crypto Twitter bubble that we really overlook those warning signs. We don't really pay attention to them. And now there's so much institutional money pouring in and institutional traders in the space. We've got to start, paying attention to all of that. So that's just kind of my soapbox on how did we miss this, right? So what I want to try to get out of this today is if everyone walks away with 3 things that are like, shit, I won't miss that next time. I think we've done, a good job. So, so really kind of on to the inflation talk. So, um, looking sort of looking at inflation, right? So let's define the CPI before we kind of dive in, right? So what is it? So the CPI represents changes in all goods and services purchased for consumption by an urban household. So how much more expensive is, I went to the grocery store yesterday, and a pound of boar's head ham was $14. I don't remember it being $14 a year ago, but it's certainly the case, right? Um, so this current 8.6% inflation is staggering. And so, let's break down some of the data points that are kind of within that. And to your point, Nick, does the Fed have the tools that they really need to work to combat this inflation, right? So I mentioned the boar said ham, right? So food. Um, Food is pretty much inelastic. People have to eat, right? Um, but the war in Ukraine is driving food prices higher. Oil prices are, going through the roof because transport is a nightmare right now with the supply chain. And actually, I have a friend that works for a tire company, Hankook Tires, which is I think pretty well known. And he told me that dealing with the shipping container companies globally, it's the highest price quotes that he has ever seen. Kind of regardless of what you're trying to ship. So, you've got a three-factor problem on your hands. Um, and the bottom line is Fed rate hikes, they're not going to fix the wheat crop, right? It's not going to change, the war in Ukraine and the supply crunch we're seeing on food. And so, that is a major problem, and it doesn't, seemingly doesn't get better without some macroeconomic changes, in the world itself, particularly around the war. Um, and then, the other piece probably, within inflation that we should look at, I think, is energy. And so, right now, I think it actually just came down yesterday. It was about $115 a barrel for crude unrefined. It came down to about 105. Um, but the bottom line is the world is buying oil from Russia, which is insane. Um, Green policies worldwide have really stopped the production domestically and the global production of oil. And our refineries are operating at like 93 to 95% capacity, which is frankly unsafe, and it can't be increased. And so at the end of the day, these rate hikes from the Fed, they're not going to fix oil prices, and they're not going to force China to reopen their ports or fix the supply chain. And so, I think as far as CPI goes, I'm not sure that the Fed's tools in terms of interest rates are going to be, super effective in the short term for inflation. So I'll stop there, and Nick, see if you wanted to jump in.
Yeah, I mean, just touching on, I mean, I kind of saw a meme yesterday, and I mean, it's not wrong. You had the German Parliament, I think it was, laughing at Trump, sort of saying, you guys are way too reliant on Russia for their oil, and this is for the gas, and this is going to crush you ultimately. At the time they took it as a massive joke, but I mean, that joke's not aging very well at this point in time. I mean, you look at the consumer price index for energy in Germany alone, and why I'm referring to Germany, I guess, here is because they essentially are the backbone of the European Union. I mean, personally, I don't see the euro lasting the next 10 to 20 years. I honestly do not think that it's going to be around. And I guess to further echo, I guess the importance of, it's kind of, this is your subject matter and this is your specialty of field, discussing US-based economics and macroeconomics. But ultimately, at the end of the day, majority of the global currencies or major global currencies are kind of orientated around the US dollar anyway. You saw the euro fall by 2 cents against the US dollar yesterday, slight recovery. Same with the pound. We saw a bit of a spike with Bojo's resignation this morning. But I think, all of this kind of mimics, why it's important to base, all of this around current US federal policy. I mean, I think, I believe there might be what do we have coming up this month? I think, who was it? It was someone in the Phantom Kings chat was sort of going on about, some of the major sort of announcements we have coming up. I think there's CPI or inflation coming out for June.
Yep.
What's that, in like a week or two's time?
Yeah, there's a CPI print in a week. There's
Correct.
FOMC basis points on the 16th, I believe, and then the
Yeah.
GDP release is on the 30th.
Yeah. So I mean, from a cumulative macro perspective, hate to be the bear here, but it is kind of looking a little bit doom and gloom at the moment. And I mean, when you look at what European central banks have been doing, essentially just lapping around all of this, they're, as far as I'm concerned, there's a lot of posturing going on, but nothing really happening that shows that people are taking this seriously. Along with our friend JP, who is, I guess, taking more of a hawkish stance at the moment. But I mean, the proof is in the pudding at the end of the day. Clearly looking at projected CPI prints and where CPI prints have been, it's not really working at this stage. But then again, these things do take time to kick in. I think, this is. Oh, sorry. Carry on.
I was just going to say, like, my whole thing with these kind of conversations are, a lot of people listen to it and be like, well, you're just a fudder, right? Like, you're just fudding, the market's going to be fine. And like, it's, it's somewhat of it's a very unrealistic, perspective to have. Like, lots of people are tweeting about their shit coins coming back. And, the bottom line is, if the Fed's tools for rate hikes, because of the macro global factors, cannot rein in inflation quickly, which it doesn't seem they'll be able to, because they can't fix the wheat crop, they can't affect oil prices, they're not going to affect ports, et cetera. Like, we have a 6, 12, 18-month recovery on our hands, and it's just good to be realistic about that. So, like, if you look at traditionally, the Fed's going to want interest rates to be basically at par, or higher than inflation rates. And right now, the 10-year interest rate on bonds is 2.8%. The inflation rate is 8.6%. Like, that is a massive, massive delta. And so, I think it's going to be realistic.
That's a long road to that ideal 2% inflation that they're trying to get it back down to. And I don't think it's going to be a soft landing. And again, just further to sort of echo your points, it's not about being bearish. It's about being realistic and kind of to sort of, I guess, revert back to your question that you asked everybody earlier. Why didn't we see this coming? The writing was on the wall, and I feel like it's that mindset, that upwardly mindset, that hodl mindset. The hodl mindset in itself kind of is flawed in the sense that it doesn't really allow for distribution, for wealth to change hands, and for sort of I guess ownership dilution to sort of happen, which needs to happen, in terms of sustainable growth. But irrespective of that, I feel like it is just about being realistic at this point, and identifying macro factors that we haven't been studying in the past. It's about learning from your mistakes, just like we learned from mistakes in the 1819 market. It's about taking those same learnings, but in terms of different contexts, we haven't really had. I mean, ironically, crypto or Bitcoin, and I'll try move on real quick here. I'll just give one last spiel and then we'll move on to the next topic. But ironically, Bitcoin was created as and I say this with quotation marks, indentations here, a hedge against inflation. Well, that's not the case. It's a speculative store of value. We can argue about the nuances of Bitcoin and other cryptocurrencies at another point in time. And I'm not being bearish on crypto here by any means. I feel like the practical application of blockchain technology offers so much to the world, and I feel like we're just scratching the surface on it at the moment. But at the end of the day, the most important takeaway here is to identify, macros, or identify key factors that we may have missed in the past, and make sure that we don't miss them again. Without me continuing to rant here, I'll move on to the next chart that I think you requested that I throw up here, Clay. So the core inflation and real policy interest rate percentage. Do you want to chat a little bit about this?
Perfect. Yeah. So really, I just kind of wanted to illustrate how bad this inflation situation actually is, right? So like, what is the Fed actually dealing with? And again, this is domestic to the U.S., but what you're effectively looking at. So core inflation is the CPI, less food and energy. So it's just another way to look at CPI with a little bit different metric. But if you look all the way to the right, basically, the real policy interest rate is the Fed's fund rate. So for the longest time, that was 0, right? Minus the core inflation rate for the previous 12 months. So if you were to look at January 2022, the real interest rate was 0, and inflation 6%. So we've got a minus 6% real interest rate effectively. And so looking back through history, the last time that we saw anything like this was really like 1975. And you can see that it was a 17% gap back then, and we're at a 12% gap right now. So I think it's just good to draw context to how kind of brutal the situation actually is, and why the Fed is so hawkish, because this is a great visual representation. And back from 75 to 83, I wasn't alive, but I've read about it, and basically to reduce inflation to 4%, the Fed had to raise 1,300 basis points. And unemployment rose 600 basis points, and we're going to talk about unemployment in a little bit. But not to say that I don't think that's going to happen here. Like, I think we're in a completely different time. The energy crisis of like the late 70s, early 80s is quite different. But and the Fed's done a really good job over the last 40 years at keeping inflation around 3%. But we do have a massive uphill battle ahead of us, and I think this is just a good way to kind of showcase it.
Absolutely, and I guess a great sort of intro into the next topic. That being the importance of bond markets and interest rates. So I mean, Clay, perhaps give us an overview on why bond markets matter. But first, maybe a little bit of background into what government bonds are, their purpose, and why they're pertinent in times like this.
Yeah, of course. So I think this is the section where we say, Clay, thanks for the doom and gloom.
Yeah.
Where were the warning signs, right? Like,
Yeah.
so I mean, honestly, I think we've been teeing up like kind of the gravity of what we're dealing with, and the true global macro situation that's on our hands. But through the next sections, we want to point out where were the warning signs, and what could we have done and taken in informationally in the crypto market to maybe take some profits or get ahead of this, right? So the purpose of government bonds is to raise money and operate the government, and to pay down debt. And for a little bit, just so you guys have some context here, I'm really going to focus on 10-year yields. So they're called notes. And 10-year yields are traditionally, they kind of influence mortgages and interest rates. And we'll also focus on 2-year yields, which are influenced by Fed rate hikes. So sort of short and long, a short duration and a 10-year bond. So just for some context. But there's not many things that are a better economic indicator than the bond market. I think probably we should lay out some examples of kind of the components of bonds, and kind of how they've tied into the Fed at least here in the past few years. So it makes a little more sense. So there's three core components to a bond. There's a maturity date, so 2 to 30 years. Again, we're going to probably focus on the 2 and 10-year bond because of the yield curve inversion. It'll all make sense once we get there. But maturity date, the face value, so the amount the bond is worth when it's created, and what it's going to pay at its maturity. And finally, there's an interest rate, also called the coupon rate. And it's the fixed amount that the bond pays each year up to its maturity date. So those are sort of the 3 key components to bonds that, that if you're not familiar, and there's lots of types of bonds, we're not going to go into all of them, but a quick example, so just kind of tying those 3 components together. So if you have a 10-year treasury note for $1,000 at a 4% interest rate, every year that investor is going to receive $40 in the return of principal, and eventually the $1,000 back in return of principal at the maturity date. So that's kind of just how the 10-year notes work. Something to keep in mind here, and this is kind of with all bonds. So bond price and the bond yield are inversely related. So as the bond price goes up, yield decreases. As the bond price goes down, the yield increases, and that will be important, and I'll kind of tell you why in a second. So looking back at 2020, right? So COVID hit. The Fed turned on the money printer. They cut rates down to 0. Just max quantitative easing. They also relaunched a bond buying program to the tune of $120 billion of bonds bought each month between Treasury and mortgage-backed securities. So the Fed was trying to stimulate the economy, right? So they're pumping. They're not only printing shit tons of money, but they're pumping massive amounts of money into the bond market. And because of this, because of the, like I said, bond prices and bond yields are inversely related, right? So the bond yields fell to record lows to encourage spending. And previously issued bonds or existing bond prices went up, and so this was good for the bond market. So this program of basically buying bonds, this was a great time for bond investors. Fast forward to 2021, and we've got war on the horizon. You've got inflation that becomes a problem, and rate hikes that seem imminent. And this became a pretty key, both the key and the problem for bond investors moving forward, right? So when short-term interest rates rise, bond yields go up with it. And the issue with that is when yields rise, the previously issued bond prices fall. If we go back to our 4% bond example, right? So that 4% bond, if the yield later goes up to 5% for that same 10-year note, then basically that reduces the price of the existing bond, the 4% bond that was issued a lower interest rate as a function of supply and demand, and that bond is no longer profitable. So basically that bond becomes a losing money scenario. So let me tie this in, and then I'll shut up. But this is where we are today, and this is why I say all this. So this is exactly what we saw happen from 2021 to 2022. The benchmark 10-year U.S. Treasury note yielded 1.5% at the end of 2021. And by May 2022, the yield topped 3%. This was a negative for investors because the inverse relationship, right? So yield went up, prices went down, the bond market goes sideways. Thus, because of this, the bond market has been flashing recession warning lights at us since 2021. We just didn't pay attention. Like they've been there. And Nick, I'm going to stop, but I have
No.
warning
I'm
signs I
just
want to
saying.
point out.
I'm just thinking. We're all laughing into shitcoins, for lack of a
Right.
better term.
Right.
And like you said, the smoke detector was ringing, but everybody's asleep at the wheel. But I mean, yeah, I mean, while we're on the topic of yields, and this is again a good segue into the topic, and why they matter. And another interesting chart that you have been referring to, in the previous slide here is the inverted yield chart. So at a high level, just for the people out there, many economists sort of say that an inverted yield curve, signals an economic downturn is coming. essentially an inverted yield curve occurs, when short-term treasury yields exceed long-term yields. So Clay, what's your current take on the climate in this respect? Then we can continue here.
Yeah. So yeah, unfortunately, we probably should have had a bond chart. It would have been that explanation I just gave might have been confusing as shit without
Yeah,
being
that's
able to
okay.
look at
That's
anything.
okay.
Sorry about that.
That's fine.
But yeah, so basically, the yield curve impacts when you lend money to the federal government. This is what happens on the treasury notes. So in a normal situation, like, well, this isn't the normal one. This is the inverted one. But in a normal situation, the 10-year yields are going to be higher than a shorter duration note like the 2-year. And on your if you're basically loaning out money for a 10-year bond, you're taking a bigger risk by letting the government have your money for that longer time period, right? So you would expect higher yields. And effectively the yield curve in itself is the spread between the bank's cost of money versus what it's going to make by lending out that money. So buying a treasury note or investing it over a long period of time. And so, when it flips basically, and the economy is doing poorly, people take money, out of stocks and they put them, out of risk assets, and they put money into long-term bonds. And that higher demand causes the price of the bonds to sink. That pushes down the yield curve. And this is a massive warning sign that the 2-year yields are higher than the 10-year yields. And so why would people want to buy longer term bonds, right? So it's harder for the government to sell these types of long term bonds, and it's a massive warning sign of economic recession. And so this actual this scenario actually happened on March 31st of this year. And what's ironic about that is the same day that Bitcoin saw our third rejection off the 200-day SMA around 48,000 bucks was March 31st. So when we started this Bitcoin decline or downturn was when the yield curve went inverted. So do you think that's a coincidence?
No, absolutely not. And I think that's a perfect lead into a topic which is not next, but the following. Just before we do sort of move on there, what's your take on TIPS? Treasury inflation protected securities in this environment.
Honestly, man, I don't really have a great take on them. I don't. Not my field of expertise, honestly.
No, that's okay. No, I only ask you because I've been doing a little bit of reading into them recently. I've seen some other sort of, I guess, macroeconomists sort of talking about them and arguing to and against them. So I kind of wanted to throw you that curveball there and just kind of see if there was anything that you might have to share with the community in that respect. But I mean, because we're sort of we're getting on with time now, and I think let's push on to the next factor, being the Dixie and the DXY chart. I always love hearing you talk about that on Unchained, and to be frank, I hadn't paid much attention to it prior to you actually ringing that alarm bell. So it's a good segue into the next topic. So look, please oblige us, with what is the DXY? How does it correlate with Bitcoin? Let's dive into this.
Yeah, sure. So the Dixie is the U.S. It's basically an index, the value of the U.S. dollar relative to a basket of foreign currencies. So so the measure of the Dixie is it's 57% against the euro, 13.6% against the yen, 11% against the Great British Pound, and 4.2% against the Swedish krona, and then a little bit against the Swiss franc. And really, it's an indicator that it's a warning sign that money is moving into safe haven assets, right? So risk off environments. And it's traditionally had an inverse correlation to positive Bitcoin price movements. And so, on February 11th, when the U.S. announced that Russia could invade Ukraine, there was a warning sign. and I don't think that we really paid attention to it, but the Dixie moved from 95 to 99.42, so plus 4% in about a month. And this
It's
was
a
a
huge
massive,
shift.
yeah, it was huge. It was huge. It's a it was a huge warning sign of uncertainty, and stocks began to risk off, and capital began to flow into the dollar, right? And so, just from a traditional sense, the dollar, gold, and the Japanese yen have sort of been the safe haven assets for the modern world. The yen, not so much anymore. It's sort of lost that esteem. Um, but if you look at like the factors that are affecting the Dixie, again, it's at the highest point it's been in 20 years. It's the same as sort of everything else, right? War in Ukraine, high inflation, Japanese yen weakness, which we could have probably a full conversation around why that's happened, but it's the weakest it's also been in years. You already mentioned the euro, and then COVID-19 cases in China. They've doubled in the last week, so supply chain disruption. So as we see the Dixie creep higher, we have to assume that there's more money flowing in to risk off safe haven assets like the dollar. And so I'll stop there and let you chime in if you have any.
Yeah, no, I mean, again, DXY is not something that I've been observing or observant of until I actually heard you, start to discuss it on FTM alerts. I was comparing the correlation of Bitcoin, with the DXY earlier when I was kind of putting these slides together. And as you said, they do sort of trend and follow with each other. However, what do you think the reason is, I suppose, for this disposition? Is it kind of accumulation of the global economic affairs that are currently happening? Like I said, symptoms upon symptoms, upon causes, and what's your and again, no one has a a crystal ball, but what's your outlook on how you kind of see this playing out?
Yeah, I mean, I don't feel good about it in
Mm,
terms of just the strength. The war in Ukraine, I haven't seen any terms of peace talks. In fact, the U.S. put 4,000
more
troops in
aggression.
Poland.
Yeah,
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 it's
yeah.
it's not good. Inflation's not tamed. The yen, the Japanese yen, they're moving it. They're still quantitative easing. We're quantitative
Mm,
tightening. So we're moving away from one another in terms of the Fed.
yeah.
And in our perspective of the world macroeconomics. So the yen's getting weaker. People aren't going to the yen anymore as a safe haven. So I expect this to continue up. And if I had to say how bad could it get, obviously it's hard to say, but the worst case scenario I would believe would be a retest of the 2002 highs at about 120. And in which
And at
case
that
that's
point, do you think we're sort of nudging on depressionary sort of area, or are we just in a very very serious recession?
um Yeah, I mean, I guess it really it kind of depends on the Fed stance at that point, right?
Mm,
Like, or do we
mm,
get
mm,
because a lot of those, that's certain, that's going to be a historical major resistance. So, most people would think that we would then come down from there. But I think it'd be interesting to the next slide. I think is the correlation to the Bitcoin price and the Dixie. Is that right?
so that was I kind of
Oh
bundled
shit,
this
it's on
one
there.
into the same slide. Yeah, yeah, yeah. It's up there
Gotcha,
on the
gotcha.
screen. Yeah.
Yeah. So I mean, effectively what we've seen, and I did a thread about this, I think back in April, but we've hit historical resistance on the Dixie twice basically, and
Mm,
both times we were rejected off of it. It triggered a major bull run in 2017 and 2020.
mm,
And so no one has a crystal ball, and it's to say that it's going to 120 is kind of a little bit ahead of my skis.
mm, mm.
We could get to 110 and get rejected easily. So, but this is something that from a forward-looking perspective, you should probably start taking into consideration because
Yeah.
March 31st was that day, and we didn't really respect the.
And
your
I think
info.
it is, again, part and parcel with that cohesive mindset, I suppose. A lot of people are talking about the Dixie now, and a lot of people will be looking for that bounce, essentially the inverse floor. And this being a major factor to consider, well, for not only retail, but, institutional to sort of consider, their re-entry points there. So, I mean, look, as we're nearing, sort of the hour, let's push on with the final topics here. And,
Cool.
and let's kind of, start. Oh, sorry, Clay, did you have anything
No, keep going,
extra you
keep
wanted
going.
to add there? Yeah. Um, Start our sort of winding down and our conclusion on a discussion tonight about the big question, what's next. I watched your show earlier. I heard you talking about the Phillips curve, which is basically an inverse relationship between employment and inflation. What's your outlook on this? And perhaps with my sort of poignant take on the forecast and what you're probably going to say here, with earning potential declining not only in the job sector but also the investment space, what would you consider a good thought process when when conducting a earning per share revision?
Well, I mean, so Microsoft just did an earning per share revision. I mean, I think
Hmm.
there's two factors here. So one, I am a believer in the Phillips curve. I do think that we're going to have to see increased unemployment before things get better. And think I gave on the show a couple examples, but the main one being
Meta just had a massive, well, not
yeah,
cull off, I suppose, but they came out with some very staunch sort of wording. You've got who was it, Coinbase, basically, informing their employees
Yep.
of their redundancy. Uh, Via an email to their personal address because their their actual company addresses had already been revoked. So I mean, and I guess erring on what I heard sort of Nick discussing here and the sort of overflow impact into valuations here. A lot of these companies, and I'm stealing this from Nick Dracon, by the way. These aren't my thoughts, but I do agree with them, and he said it very well. A lot of the valuations on these companies, have been based on growth projection. A lot of these employees weren't necessarily needed, but during the growth phase and R&D and all of that, if your competitors are hiring, you need to hire in order to stay agile. Good friend of mine who works in Microsoft has just said that he's been pivoted, context switched, between I think it's been 3 different main projects over the last couple of months, which is quite huge. And that's purely because the human resources aren't there. So now they're kind of pivoting to sort of try and stay ahead on what's relative, what's relevant, what the competition is doing, and where their research and development needs to be. And so I guess the overflow effect here is with all of these major tech companies sort of being priced in at a growth projection scale, with a wind down of employment sort of happening, and therefore I guess being less agile with the R&D, those valuations are going to kind of fall off a cliff edge. Carry on.
I mean,
Phillips
no,
curve.
no. I mean, I think you said it perfectly. I mean, another great example, because some people are like, well, it's a tech stock and the tech company's down 40%, and I
Wow.
agree. Well, let me give you a different example though. Like my buddy, here is he owns a mortgage loan officer, so he basically employs
Mm.
mortgage loan officers. Of 100 new loans, how many do you think were refi loans?
Oh
So if you had
God.
to guess.
Uh, I don't know. Tell me.
So 75 of 100 of
You're
over the last
kidding
year
me.
were refi loans, because
Refinance.
think how low interest rates were. Like, you're almost a fool
Yeah.
not to refi and lower your payments. So now with interest rates at 5.6% for mortgages, do you need 100, if you had 100 employees and 75 of them are doing refis, who's refinancing now? The answer is no one. And so
Mm,
I think that we're going to see some crazy shakeouts in different sectors, and unemployment rates are going to rise, and the Phillips curve probably is going to come to fruition. And
mm,
on the earnings per share you were talking about, I mean, I think Microsoft brought their revenue expectations for Q4 down 2%. So $1 billion based on the 53 billion projection. So
Wow.
down to 52 from 53, so about a 2%, and it was a 10-cent cut on earnings per share. So I think that stocks are probably in for a difficult time ahead, and
Mhm.
the downturn price action may not be over. And this is just the first of probably many examples that we're going to see. So stop there.
Yeah, absolutely. Yeah. I mean, any take on the current market conditions? I mean, you've got most markets up as of today,
Yeah.
and again, sort of echoing, what Nick sort of said, and again, I tend to agree with him. Could be a good time to take out some shorts, NFA, of course, but I mean,
Yeah.
why do you think these sort of sudden and drastic spikes are sort of happening despite the looming doom and gloom that we've been talking about for the last 50 minutes?
Yeah, I mean, capital still has to flow somewhere, and there's,
Mm.
every time that there's a 10%, whatever the pump was on Bitcoin, I assume that there's an equal amount of shorts that are coming in,
Oh yeah.
making money on both sides. Smart traders are playing this market in order to make money, where, a lot of us are on the sidelines, not with that perspective or mindset. But like in terms of the
Yeah.
market as a whole, I think the biggest takeaway is like this is not a V-shaped recovery like we saw in
No.
COVID, right? We're
No.
still feeling
No.
the effects of March 2020 bailouts. A ton of companies should have folded back then. They didn't. And so that debt is still on the books of lenders and the central bank.
Mm.
And I think that we've got some rough times ahead, but there is good news, in my opinion, as well, more longer term.
Which which is I guess a perfect place to sort of wrap this up. And I'm surprised we've actually managed to fit all of this in within the hour. But I guess look, let's wrap it up with some good news. What's your with all of this said and done? Do you
Yeah.
have any good news for us, Clay? Let's wrap this up on a positive note. What's your outlook over the next, say, 12 to 24? Where do you see things heading, man? Again, remembering no one has a crystal ball, but we're here for your opinions. So let's hear them.
Yeah, of course. I think a few key takeaways, are that we need to follow, the events of the bond market more closely. I didn't get to
Mm.
read there. There were basically within that the March 21st timeframe to Jan 2022. There was basically three statements by the Fed and a Wall Street Journal article that all sort of predicted this. And so,
Mm.
following
Mm.
the warning signs of the bond market is huge. Following the warning signs of the Dixie is huge. But on to the good news. So, I mean, in my opinion, you know, BTC price action has actually been pretty strong relative to the Dixie strength, right? Like I think we had a 4% jump in Bitcoin today. So, it seems like there's only so many sellers in this market at the current prices. So I find that to be encouraging. Um, and as we see the old world tightening, JP Morgan still wants crypto to be bigger than real estate. And so, if lending is really no longer there, as a really profitable, viable business option for loans for them, like where is the opportunity at that point, right?
Yeah, absolutely.
And I think it's Bitcoin and Ethereum, right? So, I think we likely see a shift to a digital asset ecosystem. I'm not saying it's going to be tomorrow, but
Overnight,
um,
yeah.
yeah. And but what about
It's
yourself?
a Well, again, I absolutely agree with you. And I feel like you guys again going back to Unchained just because you guys have so much good shit on there, but we talked about sort of the rapid incline, during the COVID era, and it was kind of like the perfect storm. You know what I mean? And so I kind of see this decline and just mimicking what you've just said here as kind of creating the perfect storm for not a drastic shift to take place. It's going to be over a period of time, but at least to create an environment for that shift to start to happen. As you said, equity has to flow somewhere. And I feel like this definitely isn't the end of crypto. We've been through these market cycles before, and it's more about I guess, yeah, paying attention to these key indicators and being more I guess having a sharper mindset as to which indicators you're actually looking at, taking learnings from your previous mistakes, taking learnings from the market's previous mistakes. Don't over leverage. Look for opportunities, do better research. But most importantly, just don't go following like people on Twitter who are sort of saying Phantom's going to hit $10 in the next year or something like that. I mean, it's just
Yeah.
it's not feasible, especially in the current environment, and especially considering some of the macroeconomic factors and I guess social factors and yeah, so forth that are sort of manifesting themselves today.
Yeah, I mean,
So
a couple things I want to add to what you
mm,
said. So, I think something that we really have working in our favor is the crypto markets can handle volatility. Like, if you look at traditional markets, like they're not reflexive. Like, if the Fed continues down this path forever, traditional markets are going to crumble, and the
mm,
Fed simply they can't do that forever, right? So,
mm,
if you look at Bitcoin, we've had what seven drawdowns of like
yep.
70% or more, and it's
Mhm.
in its life cycle, and so I think we have to keep in mind sort of how kind of things have worked traditionally here. And I'm also encouraged that, the VCs are still out there and they still seem hungry. I know, Phantom just got a $15 million
Yep.
cash infusion from a VC recently.
Hmm.
But, I think the main takeaway is you really need to stay patient. And I think Nick Dracon does an incredible job on Unchained of talking about how there is no rush, right? If you're
Yeah.
sidelined, there's a ton that still needs to play out, and there's really no rush. But we are in a really reflexive market that I think can handle this kind of volatility. So it's
Yeah.
I think there's still a lot of positives.
Patience is key. Yeah, absolutely. And I mean, echoing that, when you guys do decide to sort of or feel the bottom is in, or you want to start to re-enter for those that are sort of hedged at the moment, an interesting tactic that I saw mentioned recently was the DCA up rather than the DCA down. Sometimes it's better to I guess take a more expensive position in a upcoming market rather than trying to catch the falling knife. So wait until you actually bottom is confirmed, and it never hits sort of DCA up, because if the market is going up, you may find yourself in a not as good DCA dollar cost average position buying up, but at least that there is some kind of turnaround in the market at that point in time. Again, just an interesting strategy that I saw discussed, not recommending that people actually do it, but food for thought there.
Yep.
But I mean, look, we're pretty much on the hour now, man. Thank you so much for your time. It was an absolute pleasure having you on with us today. And thank you for your insight. Before we sort of wrap this up, was there anything else that you wanted to conclude with?
Um, No, not really, man. I think first of all, thank you for having me, and I apologize I didn't
Pleasure.
have a bond flow chart of how things work. It's probably confusing, and I apologize for that.
That's
But uh,
that's fine,
but
man.
no, I mean I think like it's for me it's all about getting smarter and really understanding these macro indicators, and honestly
Yeah,
like I've done a poor job myself of listening to the market and understanding 3 to 6 months out. Um, how these things are going to affect the price of Bitcoin, which affects everything else. And Austin says it all the time, but you know, if you're long this ecosystem, if you're long, Bitcoin, then I've been dollar cost averaging into BTC because if it
mm,
goes, from 20 to 12, and I'll continue to do so because I believe long term, my time horizon is multi-year.
yep,
So I think the stuff we're talking about is let's take profits when things start to flash warning signs, and
yeah,
hopefully we can get better at that.
absolutely. No, absolutely, I agree. It is, and I mean that kind of embodies, the um, overarching reason for us hosting these fireside events and for having today's discussion with you is making sure that we're taking learnings, having learned discussions with one another about, various ideas and various techniques to, um, better our habits, better our investment strategies, sharpen the knives, so to speak. And yeah, look, man, it's been an absolute pleasure. I can't thank you enough for your time, Clay. To the community out there, look, thank you everybody for joining us today. Next week's Fireside Chat, we've got a little surprise in store for you. I won't leak it just yet, but be sure to keep an eye out for Degens Digest coming this week. Clay, I'll let you get on with your evening. Go and enjoy yourself, man. And look, yeah, thank you for joining us, everyone. Cheers.
Cheers, man. Well said.